Risk off dominates on Monday as global markets open after the weekend and investors react to US-Israel attacks on Iran and Iran's retaliation, which included attacks on its neighbours in the region as well as blocking the Strait of Hormuz, which is a key choke point for oil, which sees around 20% of global oil supply passing through it. Now, unsurprisingly, oil prices are up over 7% at the time of speaking on fears of supply disruption. But this actually goes far beyond the oil price. High oil prices add inflationary pressures, meaning that global CPIs could rise again in a similar manner to when Russia attacked Ukraine. Now, the Middle East is the world's largest oil producing region. If shipments can't leave, prices rise. Higher inflationary pressures may require central banks to stop their rate cutting cycle and even start hiking interest rates again. This could see yields rise. Now, European stocks are falling with the German DAX around 1.8% lower. The FTSE is down around 1%, whilst US futures are also trading well over 1% lower. The VIX index, also known as the fear gauge for Wall Street, has jumped 26% to a level last seen in mid-November. The US dollar is also rising. Let's not forget that the US is a net exporter of oil, so the dollar is benefiting from the higher oil prices, also from its safe haven demand. Meanwhile, safe havens such as gold is also up 2% to 5,400. The Swiss franc is another safe haven to keep an eye on. Where we go from here, a lot depends on how long this war actually lasts. A quick end could see prices rapidly recover. However, this is looking unlikely right now, and prolonged and persistent war, high oil prices, and could see an ongoing reaction in the market, supporting safe havens, undermining risk assets, and raising inflation worries. Now, news flow is likely to drive trading this week, meaning investors will need to be reactive in difficult conditions, with headlines likely to drive moves and volatility.